Malpractice insurance does not cover bad doctors, but it covers good doctors that operate in a litigious society. And that's what we're in here in America. Believe it or not, one is more likely to become disabled during their career than to pass away during their career. Pay for your policies post-tax. That'll put you into a really strong financial position in the unfortunate event that you actually need it.
Welcome back to Generational Dr. Wealth, a personal finance show for doctors. This podcast is for educational entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult your own professionals.
Hello. Welcome back to the Generational Dr. Wealth show, a personal finance show for doctors, you out there. And today we're going to be talking about a very important topic, and this is step one of our financial blueprint to financial freedom. And this one's going to be focused on ensure your foundation. Now, what exactly does that mean? It means that being doctors, you are opened up to a different amount of scrutiny when it comes to the legal system, especially here in the United States. Meaning that when people see doctor, it opens you up to a different realm of possibilities when people are trying to unfortunately sue you or unfortunately not make sure you're properly protected. So we're going to talk about the three main kind of insurance types that we need to make sure that we are in a solid financial foundation, to make sure everyone that we love is protected. And in the unfortunate event of something happening, they are taken care of. Now, we're going to break it down into three main buckets. Number one, we like to call professional liability insurance. Again, here on a Dr. Wealth show, we like to speak in the affirmatives. So you hear it often called malpractice insurance. We like to call it professional liability insurance. And basically, this is the insurance you take out to make sure you protect your license. In the unfortunate event of a lawsuit against someone's license, this is what will step in and help protect you. And what we like to say is that malpractice insurance does not cover bad doctors, but it covers good doctors that operate in a litigious society. And that's what we're in here in America. Number two, we're talking about income protection, often known as disability insurance. This one is how you protect your income. Absolutely key, because understand, when you're earning these dollars, it's not guaranteed that it'll be going on into retirement. Believe it or not, one is more likely to become disabled during their career than to pass away during their career. So it's important to make sure you protect your right to earn, protect your income. Because to get to this spot, you probably had to take out student loans. You probably took out a practice loan. You already have mortgages on your head. You have a lot of different things that are operating with the trust that your income is going to continue at least until the foreseeable future. How do you protect that? You do that with income protection insurance. And last but not least, we have term life insurance. Now, this is an insurance product that replaces your income, and not month to month like this disability or income protection insurance does, but year to year. So we're going to get into what is the appropriate amount of term and life insurance to carry to make sure you're in a good space. Now, I'm going to give you a little bit of a hint. It depends on where you are in life. It depends on what you're responsible for. Do you have a mortgage? Do you have kids? How many kids? How old are they? Are they self-reliant? Are you the sole means of providing for them? Are you a stay-at-home spouse? Are you dual earners? See, all this factors into figuring out, is this the proper amount of insurance for you? So now let's roll it back a little bit. We said we have three main kind of insurances we're going to go over today. Number one being professional liability insurance, aka malpractice. Number two being income protection, aka disability insurance. And number three being term life insurance. You ready to get into it? Let's go. All right, so let's hop into malpractice insurance. Now, this insurance is key to make sure you protect your right to do what you love, to do how you help those who depend on you on a day-to-day basis to provide the kind of care that makes their heart open back up to healthcare. Because for a lot of people, they've been scarred when it comes to healthcare. And you out there, you have provided a certain level of quality of care that makes people believe again in healthcare. I know in dentistry, a lot of people have always come in and say, I am afraid of dentists. And I take that as a personal challenge. How can I make you believe again in your ability to smile? Now, there's a whole generation of people who unfortunately got procedures done under inadequate or no anesthesia, and they are unfortunately afraid of dentists. But the next generation that's coming up, they're open. They're saying, depending on my experiences, how I'm going to think about dentists moving forward. So I take that as an opportunity to do what I love. And that for you out there as well. But understand, as doctors, we have to make sure we protect ourselves. Again, being in a very litigious society, meaning that a society that seeks lawsuits very, very often and very, very common, you understand malpractice insurance is not to defend you in the midst of you doing something wrong, but it's also in the midst of you doing the right thing. You could do everything completely right, and unfortunately, a lawsuit can still come someone's way. Now, we don't wish this on anybody, but unfortunately, it happens, and it happens very commonly. Now, before there's even a chance for a lawsuit to come someone's way, you want to make sure you have the proper malpractice insurance in place. Now, understand that when it comes to the defense of your license, that alone could be financially devastating. So some people just think like, okay, professional liability insurance is only in place if I slip or I do something wrong. Like, no, it could be you doing everything completely right and you just defending your brand, your reputation, your goodwill in the community could be financially devastating if you have to do that out of your own pocket. So when you have that professional liability insurance in place, it gives you the opportunity, it gives you the right to defend yourself. It gives you the opportunity to be able to share your side of the story and put it in front of a neutral third party to make sure that you are always in good standings, to make sure that someone's bad day does not become your bad year. That is absolutely key. Now, when it comes to lawsuits, you got to understand that winning or losing is not necessarily the only thing that matters. You can win the lawsuit, but exhaust so many financial resources that it becomes a financial ruin. And that's why you want to make sure you have the proper insurance in place. So now let's break down the two main types of professional liability insurance. Number one being occurrence, and number two being claims made. Now, occurrence, this is what I have. This type of insurance covers you regardless of the window during the time you were covered. So for instance, if let's say 2026 we're in right now, if anything happens for someone in 2026, it doesn't matter if somebody brings a lawsuit in 2036, you're still covered by that policy. It travels, it covers that time. So kind of think about it like, as providers, y'all know, date of service. Based on the date of service, you are covered. If the date of service matches the same date that you had coverage, you're covered when it comes to occurrence. Does that make sense? Now, the second type is called claims made. This one, you have to be insured when the claim is actually brought against someone. So for instance, if somebody had coverage in 2025 and they did something in 2025, unfortunately, that the patient wanted to bring a lawsuit against them, and the lawsuit was brought in 2027, and in 2027, they don't have that same policy, or they're not covered by a policy that is claims made, or don't have what we call tail coverage, then they're going to be in a predicament. They're falling into a gap in a window of coverage, which no one wants to ever be in. So that's why I like occurrence, because it covers you time after time. There's not going to be any gaps in your coverage. When it comes to claims made, if there is a gap in coverage, you're going to need what we call tail coverage. Tail coverage is, let's say if you're getting your insurance through your employer and they're providing you claims made insurance, and let's say you depart from that employer, you want to get what they call tail coverage to make sure it continues to protect you even after you've exited that particular role. Now, this is going to be key because when people enter retirement and they had claims made throughout their entire career, it's important that doctors have that tail coverage in place, because as you go into retirement, you don't have to worry about 10 years into retirement, a claim being brought against someone. That is a very bad spot to be in. So again, let's break down the two different types of insurances. You have the occurrence, which I personally have, that I love because it covers you for the window of time that you're operating in. Okay. Now, again, if we're in 2026 and I have it from January to December in 2026, you're covered throughout. Anything that was completed throughout that year, you are covered for regardless on into the future. Now, claims made means that you have to be covered while that claim is being made against someone. For instance, if we're in 2026 and a claim is being brought in 2027 for work that was done in 2026, that person is not covered unless they have what we call tail coverage. So it's important. Occurrence stands alone, and claims made needs tail coverage to be comprehensive, full coverage. Does that make sense? Now, this brings up a very important topic on employer provided insurance. Now, this can be an absolute blessing, especially if you're going to be in this same employment for decades to come. Now, for me personally, I was a locums. So it means I traveled all over North and South Carolina providing care. So for me, it was important that I always provided my own insurance because I needed to make sure I was protected. I couldn't rely on my employer. So now, if you know you might not be at this same job for 5 to 10 years, or honestly, I would just go ahead and treat everything like you won't be there for 5 to 10 years. If you end up being there 5 to 10 years, perfect. But if not, it puts you in a very interesting predicament when you have claims made and if your employer is not going to cover your tail coverage. So you got to kind of ask that on the front end. Hey, I thank you so much for offering insurance for me. Can I ask you a quick question? Is it occurrence or is it claims made? And if they don't know, no worries. Can I get the phone number to the rep that maintains this plan so I can ask them? And then from there, they'll be able to give you the details. Now, if they say, yes, we provide insurance and it's claims made, perfect. Thank you so much. Now, quick question for you. Do you guys provide tail coverage onto that? Or is that going to be a cost to myself? Either way, it's okay. They don't have to cover your tail coverage, but it's important for you to know on the front end before you engage into that particular policy. Does that make sense?
If you've been listening to the show, you probably heard us talk about the doctor's blueprint, the 9-step framework that helps doctors go from 6-figure debt to financial freedom. But a lot of listeners have asked the same question. How do I apply this to my own situation? That's exactly why we created the Dr. Wealth Blueprint Plan. It's a personalized financial roadmap designed specifically for doctors. We walk through your entire financial picture, your debt, insurance coverage, saving strategies, investment plan, and long-term goals. And then turn it into a clear step-by-step plan based on the doctor's blueprint. If you're interested, just text the word blueprint to 704-336-9313, and we'll send you the details and application. Again, that's blueprint to 704-336-9313 to learn more about the Dr. Wealth Blueprint Plan.
So number 2, let's talk about income protection, what people call disability insurance. Now, this insurance is so important because understand, you probably did 4 years of undergrad, 3 to 4 years in your doctoral program, maybe did a master's in between, a fellowship or residency after. That's a lot of time and effort to put into your career and not make sure that your ability to earn is protected. Because usually a lot of costs are associated to get to this point to put that DR in front of your name. So the point of this insurance is to make sure your income stream never stops. Now, let me go ahead and break down a little bit of the details just about in generality on all policies, and then we're going to get into some things you need to make sure are included in your policies. Number 1, you need to pay attention to what is your waiting period. So meaning that if someone unfortunately becomes disabled today, when will they start getting paid out from the disability policy? Now, policies can range from 30-day waiting periods to 180-day waiting periods. The sweet spot tends to be a 90-day waiting period. And that's why you generally hear having 3 months of expenses, but we here say have 3 months of income because if something happens and you have a 90-day waiting period and you don't have 3 months saved up, you're going to be in a very tough spot. So if you're choosing to do a 90-day waiting period, then you want to make sure you have income stashed away in the unfortunate event of something happening. Now, if you don't like to keep cash stashed away, you can always move down to a 30-day waiting period, but just understand those policies are going to be a lot more expensive. So let's move forward with the understanding of 90-day waiting period, because that's personally what I have on all my policies. A 90-day waiting period. Now, number 1, you want to make sure you have some income put away to get you through those 90 days. But then you also want to keep in mind when and how to make sure you timely file your policy in the event of something happening. Now, when it comes to the waiting period, that's one consideration, but now the next consideration has to deal with the policy itself. And one thing I like to make sure everybody always has is a partial disability rider. This one is key because this one continually pays even in the event of somebody not being able to go back to work full-time 100%. This provides a partial benefit equivalent to how much you're actually losing in income from not being able to be full-time. For instance, let's say you make $100,000 a year. And let's say due to someone becoming disabled, they can only go back to their job part-time. Let's say half of the time, and they're able to bring in $500,000. According to the policy and the numerical values, you'll obviously do the equations, but then your disability policy will also still kick in some resources to help make you whole in between. Now, it's not going to take you all the way back to $100,000, but let's say if you're only able to make $50,000 working half-time, and your policy is able to kick in another 30, that'll bring you to 80, which is a really good place because that's 80% of your previous income. See, our rule of thumb is make sure you have at least 70% of coverage to make sure you're in a good space. So when it comes to partial disability, if you don't have that partial disability rider and someone becomes disabled and they're able to do just a part of their job, the carrier has the right to say, well, we're not providing any benefits because you have the ability to work and at least earn some income. So that's why you want to make sure you have this rider inside. Now, another rider that is so key is what we call own occupation. So now when it comes to the insurance companies, if you don't have this own occupation rider in it, they can say, well, do you have the ability to work at all? Now, if you are a neurosurgeon and you have the ability to work at Walmart as a greeter, no offense to that at all, but it's two completely different levels of complexity to those jobs. Now, if you're not able to perform the surgeries you used to be able to perform, but you're still able to physically get up and say hello to people, they can say, well, you still have the ability to earn an income we're not paying. That's why you want to make sure you have own occupation rider inside of your policy, meaning that if you can't do your own occupation, you are entitled to compensation underneath your policy. Now, again, these are two good riders that are very important. Now, let's talk about one rider that I don't like. And this is called the COLA, which is the cost of living adjustment. And I'm going to get into specifically why I like it, and I'm going to talk about why it could work for you. Personally, when I was reviewing my policies and I was looking at how much it costs for what we call a COLA, cost of living adjustment rider on our policy, it equated to be like 20% of what I was paying total for that adjustment. Now, the COLA itself is basically a way to make sure that your policy keeps up with inflation. For instance, if you have making a certain amount, it'll increase maybe 3%, 2%, 4% to keep up with inflation without you having to manually go back in for testing every single time. So it gives you the ability to increase your policy automatically. You just increase how much you pay. See, at first, I didn't know it was based off of you having to continually pay. I thought I pay for the rider and then it automatically goes up and the premiums are already taken out of my COLA rider. That's not how it is. What happens is you have the ability to increase your policy, but you still have to pay more. So I said, that doesn't make sense. Why would I pay 20% of my premium to have the ability to pay more and just skip medical underwriting? So what I did was instead, I canceled the COLA and I do what I call a reevaluation of my policy. And what I do is I provide new financials and I show them, hey, this is what I'm making now. It's more than what I was making when I first graduated. I need more coverage. And this is something you want to do regardless, because as you continually earn, you want to make sure that you maintain at least that 70% threshold of replacement of income. So if you go from earning $100,000 a year and you have $70,000 worth of coverage annually, you want to make sure if your income doubles to $200,000 a year, you're not still stuck with that $70,000 policy. Because guess what? That, as you think about your new income of $200,000, only covers 35%. You are woefully underinsured. So you want to go back to the carriers and tell them, hey, I want you to reevaluate based off my last year's tax income. I want to provide any documentation you need, but I need a new policy underwritten to make sure it matches my new income. So that now they'll go back and do all the number crunching. They'll come back to you and offer you an amount. So for me, when I took off my COLA and I showed them new income, it actually ended up being a wash. Meaning that, let's say if I was paying $500 a month for my disability policy, as well as the COLA adjustment rider, and let's say it provided $10,000 a month in coverage. Let's say I got a new policy that now covers $15,000 a month. The amount that I was paying minus the rider in the new policy was the same as I was paying previously for a 3% increase opportunity. See, that's why it doesn't really make sense. That's why I hate that rider. One thing that I would say is COLA can be a very good rider if you're in a more mature phase of your career, meaning that your income isn't fluctuating too much. You know how much to expect month to month. This is when a COLA can be a nice rider to make sure you have those constant bumps in how much coverage you have. But if your income is continually increasing year after year, you want to make sure You don't lock yourself into that COLA adjustment, but you have the opportunity to revisit how much you're actually making. So one thing I always suggest is going back to your carrier and having an increase in your coverage to make sure you're maintaining at least 70% of coverage. And once your income stabilizes, then you can think about adding that COLA rider on. Does that make sense? Now, the last differentiation you want to make is how are you going to pay for your policies? And I know this seems like maybe not that big of a deal, but this is honestly one of the biggest deals when it comes to disability policies that is not talked about. Now, I'm going to quickly break down what it means pre-tax and post-tax. So when you get a paycheck, let's say you work for an employer. Your employer calculates how much you're owed. They send a portion of that off to the state and the federal government, and they drop in your bank account the difference. That is considered post-tax dollars. It's already been taxed. The federal government and the state government or local municipalities have already been paid. Now, before they do the calculations, you technically have a gross pay. That gross pay, no funds have been sent to the government. So that's considered pre-tax. So those are two different pools of money. Now, you can use either of the two pools of money to pay for your policy, but understand how you pay for that policy is going to dictate how that policy pays you in an unfortunate event that you actually need it. So now let's start with pre-tax. Because those dollars have never been taxed and you're using that to pay for the policy, technically, if that policy ever pays you, that policy payment is considered pre-tax as well. So the government still needs to get paid, local, state, federal, they still need to get paid before you get your benefit. So meaning that if you are entitled to a $10,000 a month benefit and it's pre-tax, they can take anywhere between 35% of that income and you're left with $6,500, which is still better than nothing. Don't get me wrong. We still need to be appreciative. But at the same time, that is a pretty big chunk to take out, especially when you're only factoring in 70% of your income and no longer having the ability to increase someone's income because they're in a disabled state. Now, let's talk about post-tax. This is how I fund my accounts. This one is key because you've already paid taxes, like we said. Before the income hits my personal account, the federal, state, local municipalities have been paid out of my paycheck and I get what's left. I use what's left to pay for my policy. So in the unfortunate event of someone actually filing a claim and needing a disability policy, let's say with that same $10,000 of coverage, that $10,000 of coverage now goes straight into your bank account because it came straight out of your bank account. It's already been taxed. So on one hand, pre-tax, you're walking away with maybe $6,000, $7,000, $8,000 because you got to pay taxes on it. If you pay for your policy post-tax, you get the full $10,000. That's going to be a big key, especially if you're relying on this income for the foreseeable future and not knowing when you're coming back from that disabled state. That's why I always recommend to everyone out there, if you have the ability and you can afford it, pay for your policies post-tax. That'll put you into a really strong financial position in the unfortunate event that you actually need it.
Hello, I'm Jonathan with Team Financials, and here at Team Financials, we make filing simple, accurate, and stress-free. Tax season does not have to be stressful, and we are here to make it as simple and stress-free as possible for you. Whether you need help with your personal tax return or your business owner looking for expert tax preparation, our experienced team is here to guide you every step of the way. We don't just file your taxes. Our slogan here at Team Financials is we educate so you can elevate, because when you understand your finances, you make stronger, smarter moves for your future. If you mention Dr. Wealth with filing with us, you will receive $75 off your personal and business tax preparations. Ready to get started? Please reach out to us at 704-412-4242 or book directly on our website at teamfinancials.com. Take care. Have a good rest of the day. Bye.
Last and definitely not least is what we call term life insurance. Now, I'm sure we've all heard of different kinds of insurances, especially when we hear whole life and index life, term life. This one I like to keep very, very simple. I like to always say, don't make your insurances your investments. Keep your insurances, and your investments, because anytime they commingle, one part has to give up a little bit to be better. Does that make sense? So for instance, if I'm depending on an insurance to be my investment avenue, there's no way it can be better than an investment. And if I'm depending on an investment to be my insurance, there's no way it can act better than my insurance. So I like to always keep both parties separate. So When we're talking about insurance moving forward in this conversation, I want you to be thinking, how do I replace my annual income? Not necessarily how I build cash value or how I use my policy to create an infinite banking. No. Listen, if you're knowledgeable about that and you provide those policies, then good, you can do that for yourself. But for a vast majority of doctors out there, we're being sold a lot of these policies that we do not need. Listen to me out there. If you don't understand it, do not buy it. And this is key because guess what? You are, if you're listening to this, in the top 5% in the world when it comes to intellect. Meaning if you push through and you became a doctor, people rely on you on a day-to-day basis to provide them healthcare. They provide on your skill set, your knowledge base, your ability to digest information and to give them groundbreaking research. They depend on you for that. So if someone's bringing you an investment opportunity mashed as insurance and you don't understand it, trust your gut feeling. If I don't understand this, I probably should not invest in this. Now, the thing about it is what all can be covered through this policy I'm going to talk about right now, which is called term life insurance. This is as simple as it gets. You buy a policy called a term, and the reason it's called a term is because for a fixed amount of time, meaning you can buy a policy for 10 years, 15 years, 30 years, as high as 35 years I've seen. You can get a policy that covers you during those working years, or you can get a policy for a loved one during those working years as well. Now, term insurance is so good because this is usually the cheapest kind of insurance you can get to replace your annual income. Now, what is a rule of thumb for coverage we should be thinking about? At least 10 to 15 times your income is what you should be thinking about replacing. Meaning, if you make $100,000 a year, you need to be looking at least $1 million policy to upwards of 1.5 million just to get started. And that's just talking about replacing your income. So when it comes to term life, you got to kind of think about it. There are stages. And what I like to say is I like to layer on my term insurance. So now if you're a brand new student graduating, you're probably not going to have as many responsibilities financially as someone who is mature in their career path. Meaning that starting out, you might have no kids or maybe one kid, newly married, no mortgage. When you're more mature into your career, you might have 3 kids. You might have a home or 2 homes. You might have a practice. Those are 2 completely different types of needs. You got to think beyond just replacing your income at that point. But a nice rule of thumb is 10 to 15 times when you're just getting started. As you continually now build your financial foundation, now you want to start thinking about what are expenses that I should expect in the future. Do I want to leave my spouse being responsible to pay off the mortgage? Do I want to make sure that my kids have the ability to go to college debt free? Now you start factoring those kind of things in. For instance, let's say 3 kids, you want to make sure you send to college, you want to make sure your mortgage is paid off, and you want to make sure you replace your income. So a nice foundational step is go ahead and replace 10 to 15 times your income. That'll at least make sure that people that love you can mourn in peace without having to mourn the financial loss as well. Now, if you make $100,000, you're going to get a policy for about $1 million to 1.5. Then let's say you have about 3 kids. And when they go to college, inflation adjusted, it's going to cost $100,000 to get them through undergrad. Then that means you want to make sure you go ahead and lock in a policy now that covers the 3 kids. You can either do 3 individual 100,000s, or you can do a $300,000 policy to make sure that education is covered. That policy is the education policy. Now you can have the 1 million to 1.5 million, that be the income policy. Now you don't want to leave a mortgage behind. So let's say you have $500,000 left on your mortgage. You can do a $500,000 mortgage policy. Now you see how you can start layering these policies on to make sure you cover the most important expenses in your life? Or what you could do is just take a big step back and just roll it all in together and get a $2 million or $2.5 million policy that covers everything. That's how you got to kind of think about it. But again, the base level is at least get 10 to 15 times your income covered. If you have that, you're already in a really strong position. And when you get it in a term policy, you're paying the least amount that it costs to insure you. And now that's going to create excess. Because what happens is when you use a lot of these other products that are a mix of investments and a mix of insurance, what you actually do is you pay what we call a premium. You pay a higher amount beyond what it costs to insure yourself. And what happens is they take the cost of insurance out. Let's say if you pay a $100 premium, it might cost $10 of that premium to insure you. The other $90 go into the different products, let's say cash balance, let's say index whole life, it goes into all the products that make it work. And in certain scenarios, it could be a good thing. It could be a great thing. But when it comes to doctors, I like to keep things simple because what happens is we're bombarded by so many different financial products that makes us feel like we're making progress, but it's actually siphoning off our wealth. So what I want you to do out there is pay that $10 to your term policy and take the other $90 and I want you to invest the difference. So now, if you're not disciplined and you won't invest the difference, this won't work. But for a vast majority out there, I know you're disciplined. I know you're going to make this thing happen. You're going to take the $10. You're going to buy the term policies that you need. Again, it's not going to be $10, but we're just speaking in proportionalities, right? Then you're going to take that $10. You're going to buy your term insurance. You're going to use that other 90 and you're going to invest into strong investments, which we get into once we move through our steps of the financial blueprint. You'll get to the part where it's invest, 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 and we'll go through the actual order you should go about investing your next dollar to make sure you're reaping not only the best outcome financially, but you're also maximizing your tax situation. I've thrown a lot at you today, but this is an action-packed episode that talks about ensuring your foundation. So to recap, we have three main types of insurances that we talked about today. Number one is professional liability insurance, what people call malpractice insurance. You have to protect your right to practice. This is key. This is not an area you want to cheap out. This particular policy, you want to talk to your colleagues and figure out what is industry average. And I want to make sure I at least have what's industry average. I'm a dentist. Within dentistry, 1 to 3 million for a general dentist is pretty standard. And now it's called 1 to 3 million because the 1 million means $1 million per occurrence and $3 million being an aggregate. Usually when it comes to insurances, you're going to see two numbers like that. So the first number is being per occurrence, they'll cover you up to $1 million. Now, that means that an aggregate of all the claims in that particular policy year cannot exceed 3 million. That's where they limit their liability when it comes to the policy. So you'll see 1 to 3 million, you'll see 2 to 6 million, or depending on your particular industry, you're going to see different kinds of policies. Make sure you have a good understanding and make sure at the very least you have what is standard to your particular industry. That is going to be key. Don't cheap it out. Do not go with a company that is not going to come well recommended by your colleagues. Go with the companies that fight for you. Number two, you have to protect your ability to earn. Income protection is absolutely key because your expenses will continue to go on even if the income stops. So you want to make sure you're protecting at least 70% of your income to make sure you're in a strong financial position at all times. You want to make sure that you get the proper policy that makes sure that it has your disability residual rider. You want to make sure you have your own occupation rider, and you want to make sure, does a COLA adjustment rider fit my life, or do I need to hold off on that one? And last but not least, we have term life insurance. This is how you replace your income. This is how you protect your family and you protect your assets. You figure out how much do I earn and how much do I need to replace? How much does my spouse earn and how much do they need to replace? And one thing I always get is questions on, do I need to replace a spouse who is non-working, which we'll get into the Q&A episode because we just received a question on that. But yes, a quick hint is you need to provide insurance for everyone who is a part of the economic engine in your house. Just because someone does not physically go outside of the home to bring in income does not mean they are not bringing economic impact to your household. A stay-at-home dad or stay-at-home mom does a lot to make the home work. And in the unfortunate scenario, if something happened to that individual, it's going to cost for childcare, for dinner preparation, for clothing, for cleaning. Someone has to replace those jobs that are done in the home. That's why you want to think about the home as an economic vehicle as one, not just I work, that person doesn't work. No, it's one economic vehicle, and you want to make sure you have proper term insurance to replace your entire household economic vehicle. This was a fun episode on ensuring your foundation. Now, if you have any questions, you can send it to us. You can see the details below on how to contact us. We take questions for our Q&A segments. You can always DM us. You can send us email. We'll get your questions answered. We look forward to seeing you on the next episode of Generational Dr. Wealth. See you soon. Peace.
This show is for educational and entertainment purposes only and is not intended to be financial, legal, or medical advice. We are not acting as your personal financial advisors. The strategies discussed are general in nature and may not be appropriate for your individual situations. You should always consult your own qualified financial, tax, and legal professionals before making decisions about your money. The host and guests are not responsible for any actions you take based on the information shared on this show.